All right, welcome back to AI for 2021 Finance Summit, brought to you by Dot Data. I'm excited to introduce our next panel, 21st Century Lending with AI. Please join me in welcoming our panelists to the virtual stage.
Hi, good to be here today. Maybe we should start with a brief introduction. I'll start with myself. I'm Chiranjib Gupta. I am working with Markers by Goldman Sachs for the last couple of years, and I manage the decision management team in Markers, which includes both data science as well as the decision platform team, particularly the origination platform. I've been in the industry for almost 20 years, mostly in domain of credit card, personal loan, worked across various issuers. And most of my experience has been developing various kinds of models or trying to use it. I have some exposure to credit risk management, risk appetite management, etc. And I have to start with the brief disclaimer that all the views that I will share in this conversation would be my own and should not be construed as views of my organization that I work for. With that disclaimer, maybe we introduce rest of the people in the panel. Ravi, can I start with you?
Sure. Hi, this is Ravi Bhatia. I had the global credit risk oversight function at PayPal. This is the second line of defense. And to start with my background, I have experience close to 1.5 decades, largely in the area of credit risk, decision science, analytics. And I started in Prudential Group, then spent close to a decade with American Express, and I'm with PayPal for close to 2 years now. And my current responsibilities are basically the setting up the second line credit risk oversight function for PayPal, which include kind of defining the policies and governance, setting up the risk appetite, and doing asset quality monitoring, conducting credit risk reviews, reviewing the new credit product launches, and kind of revisiting our strategies as we are kind of re-entering into the lending.
Great, Ravi. It will be fun talking to you throughout this session. Javed, can we get an introduction from you?
Yes, hello, thank you, Chiranjib. Nice to meet everybody. I'm Javed. I'm with Metis. We do executive education in the areas of machine learning and machine learning implementation. My background is in finance and economics. I've spent some time in the regulation of credit risk in the economy, as well as building machine learning platforms in e-commerce context. So yeah, really looking forward to the panels.
Sure, welcome, Javed. And Jay, can we hear from you?
Sure, thanks, Chiranjib, and excited to be here. I'm Jay Budzik, Chief Technology Officer at Zest AI. We're a software company that helps lenders develop, operate, and monitor machine learning models. We've had the good fortune of working with a number of institutions from large to small, including the likes of Freddie Mac, Discover Financial, First National of Omaha, and a number of credit unions and specialty finance companies across the country and internationally. My background's in computer science and AI, and really excited to have a conversation today about the use of AI in lending.
Fantastic, Jay. Actually, we have a very diverse panel here today, and we can all bring in good views from each of our own domains to this conversation. So without wasting any time, let's get into our first question that we would discuss here. And so AI and lending, a perfect match or a breakup waiting to happen? So maybe Jay, I'll start with you. What's your thought?
Well, so I have a particular perspective on this, but quite truthfully, I think there is no better time for AI and lending than today. We've made significant advancements over the last several years in improving the transparency of AI models, making them sort of breaking open the black box and allowing folks to understand how each and every model-based decision is made, supporting functions like second line review, fair lending review, rigorous adverse action, reason code generation, model monitoring that now has been tested through a pretty unusual time. And so in my view, at least, there's no better time than now to consider the use of AI in lending because we just have so many more tools at our disposal that just weren't there even 3 or 4 years ago.
Sure. Ravi, what would be your views on that?
Yeah, I believe that there is a significant amount of technological advancement that has happened over a decade or so. I still remember when I started my career in decision science, we used to make like regression-based models, which were like the most time-consuming, the data and kind of building up everything, segmentation and all. It was a much Herculean task. Like it used to take like a couple of months to kind of clean up data, build up everything. Fast forward now, you put up everything in kind of some machine learning-based tool and the model outcome comes out. And it's easier for the modelers, but it kind of becomes a little bit trickier for the second line function or the review function to see how is it kind of functioning as desired. And of course, it's kind of improving. You're using lots of alternate data nowadays, which is the new oil right now versus using only the traditional data, which has also kind of increased the complexity. One thing I would say that, of course, it's working out well. It's kind of more decisions are getting automated. There is a place where there is kind of some sort of kind of breakup happens between AI and lending. That's where when the loan sizes become significantly higher. So up to a certain threshold, when the data is in the bounds, it works pretty well. But when let's say the loan size becomes big, pretty significantly large, or you see totally new trends coming in, then you require some sort of manual interventions. Like for example, last year in the COVID recession, suddenly you saw that everything just fell through the cliff. So you can't totally rely on the models which are not trained on that sort of data. So that was kind of a breakup point, but teams acted quickly to kind of fix that up. So I would say there's always like kind of a human touch which is required every now and then.
Yeah, and that would be probably true for the traditional models as well. I mean, models are as good as the data on which it's developed. And if that whole paradigm is changing or shifting, then there would be some impact. But I agree with you absolutely. And particularly for large size loans, collateralized loans, domains, I mean, lot of different type of information is required, and it probably makes sense to have a manual view there.
Yep.
Great. Javed, what would be your thoughts on that?
Yeah, so thanks, Chiranjib. I guess the question is, AI and lending, is it a perfect match, or is it a breakup waiting to happen? Personally, I'm not a huge fan of, you're getting a little bit of echo here on this. I think maybe somebody is on mute or something. So I'm not a huge fan of the question, I guess, because I get, a breakup implies it's consensual. And first of all, if you look at it this way, firm has a fiduciary duty towards its shareholders or stakeholders or whomever, and you have an important objective like increasing revenue or reducing your fraud. Why would you exclude a certain set of tools from the toolkit categorically? We don't see people doing that. It'd be kind of like saying to a kid, do your homework, but don't use a pencil, or to a carpenter, don't use your hammer or something like that. Yeah. So I'm not a huge fan of the question. I think it's a set of tools, you use the tools. The extent that you use them may vary.
Yeah, I absolutely agree with you. I mean, it is a one directional, like no doubt the future is together because there's so many great tools out there together. But somehow I feel if we think from the consumer lending industry perspective or consumer finance perspective, it is still at the early stage. The adoption rates compared to many other industries have been a little slower, and for rightful reasons. So again, I feel that it is a stage of like early stages in a relationship when you try to know each other, bring in the transparency, build the confidence that nothing will go wrong with these algorithms, and basically laying out the boundaries within which what can be used. Like if you talk about AI, ML, it's a huge, huge space, a lot of algorithms, what can be used for what purpose, those things need to be figured out. What are the rules of the game that needs to be laid out? It is probably at that stage where we all know that going forward, the usage will increase, but how to structure it, I mean, that's where probably we are.
Yeah, I would also like to add that credit is one of the most regulated industries when
Absolutely.
it comes to kind of uses of the models. There is, even before the model is deployed, which I've seen across the organization, like many pair of eyes look at what goes in, what the outcome is, and many sort of controls do exist. So
absolutely,
kind of corrected even before the things go into production.
Yeah, and I'd say just the AI tool developers have really underappreciated the need for those types of transparency and documentation functionalities that really everybody got so excited about the power of the models and the predictive results that there were sectors that really sort of rushed to take advantage without having those requirements to understand what those models are really doing. But even in industries like marketing and when you have a material business decision or business that's being run by an AI model, it's just good sense to understand how it's working so that you can assure everybody who's a stakeholder that the model is going to do the right thing and that you aren't going to end up in trouble down the line. And so I think as an industry or as a discipline, machine learning has gotten has really shifted to that problem, because in order to get greater usage, you really have to create the trust that the model is going to do the right thing in these material businesses.
Right, absolutely, completely agree. So anything else anybody would like to add to this conversation, or otherwise we can move to our next question?
I would just add real quick, Chiranjib, the motivation is kind of clear, right? You can by using machine learning models that make use of more data, you can paint a clear picture of the borrower risk and thereby avoid making bad loans or make more good loans and end up with a substantial increase in profits as a result. And so that magnetic pull towards the profitability, I think, is what's going to end up in this marriage, because it's just sort of too hard to avoid because the motivation is so clear.
Yeah, and I would say that is also good from the consumer point of view, that you don't overburden your customers with a loan that they probably cannot pay. So if you can make a better decision, you are actually helping out the customers as well. So good, thank you. Makes sense. So the next question on which we will have a bit of discussion is what challenges do lenders face when it comes to implementing AI into their processes, right? And be specific. So, and again, like Jay, given the organization you work for, maybe that will be a very appropriate question for you. So I'll again start with you.
Well, I'd love to hear your all's answer too, but happy to kick it off. I mean, I think there's a few concerns, right? One is the set of regulatory concerns that we just talked about. Historically, I think AI has had the people have had the impression that you can't understand how an AI model is operating, and therefore it's impossible to meet the regulatory bar. The advancements that we've had in the application of game theory to model analysis and the analytics that's required from a regulatory perspective, I think has really advanced over the last few years. And so we're seeing the level of transparency that that you need now through these very rigorous methods to be able to answer the questions that regulators would have about the safety and soundness of the models, about the attributes usage in the models, how the data quality affects model predictions, how fair lending outcomes are influenced. And so that level of transparency that maybe wasn't there just a few years ago is now there. And so a lot of what we confront when working with lenders is just that misconception that it's not possible to bring that transparency to models when in fact it is. The second concern that, or the obstacle that we face is a bunch of legacy technology, which I think is just sort of the status quo in banking to a certain extent. And so, we've focused a lot on developing partnerships with within the credit risk ecosystem to help enable easy integration of new model-based scores into existing decisioning workflows. And so it's not a trivial matter to sort of get all the attributes that you need to operate the model into production. And so what's needed is some innovation there to help ease that process. So it's been an area we've focused on.
Yeah, I mean, absolutely. I mean, what I'm seeing right now at my end is, again, like if I focus on implementation part of it, right? So first thing is how you implement these complex models, because these models, the codes can run into hundreds, thousands of lines, right? Unless you have a seamless process of integrating the model output into your production environment, it could be a nightmare, particularly debugging, right? If you have to debug something, you don't know where to start. The second thing, again, this more applies to some set. It may not be credit models as much, but maybe in some cases, some fraud models where you're on the fly creating features. Right? I give an example, like a transaction is happening same time in two different places, and the physical card is present. So something is wrong, but at least you have to compute that real time, that the distance between the two sides is much more bigger than that can physically happen or possibly happen, right? So you have to have that kind of a capability to real time create those attributes to feed into your models or decision-making rules to carry out. So that kind of a sophistication is required. The other challenges which we face here is more about runtime SLAs, right? Because nowadays everything is digital. Customer is waiting on the other end to see a immediate response from you. Your algorithm cannot run for ages. It has to be fast. It has to be quick, so that your decision is coming out in seconds, right? So there again, the thought needs to be done like what works faster, because milliseconds matter in that case, right? So in some cases, so from implementation point of view, this is what I see in my day-to-day job. Obviously, with that, we will have regulatory concerns, which again you alluded to, that there are many algorithms available nowadays to bring out that transparency, to create that adverse action reason code real time. But again, how complex is that algorithm? How much time it's taking to score application or process application, right?
I just add here, like as a former regulator, I'd
Sure.
like to maybe respectfully disagree with Jay a little bit. In the regulation of credit risk, we have something called the advanced approaches rule, and there are no arbitrary rules on complexity, more arbitrary limit on the complexity of the model that's employed in that context. So as an example, I worked on something called stress testing. And in the area of stress testing, the regulatory organizations pull together all the models across the various large institutions that are used for credit risk. So for one institution, that could be 100 models. And they not only stress test them on the bank side by giving a scenario, but then they replicate them internally and stress test those models internally. And I've been a part of that process. And you may not, if you have some kind of a complex deep learning model, you may not replicate exactly what the model is doing, but you replicate it based on your understanding of the model, and you require the banks to provide an understanding of the model sufficient to allow for replication. So if you've done those kind of things, I don't think there's been a dramatic increase in transparency over the last 5-10 years in that context. We've had advanced approaches for longer. What may be happening is that the models that are selected by the financial institutions are increasingly among the more complex models, which are more difficult to explain. So if you have like a regression model, you have factors, you can easily explain the factors and their importances. If you have a tree model, there's a standardized way, right? When you have a deep learning model, that's not necessarily the case, although some standards have emerged. But I don't think that there's a, the regulation is certainly a big piece of it, but I wouldn't say that it's the major challenge. I think the major challenge is kind of going forward, implementing something into your platform, which is changing pretty rapidly, and putting it into operations. So you're putting it into operations, you're productionizing it, you're getting the values in real time. At the same time, the best model for the situation just changed. So now you got to put another model into production. So how do you know when is the time to make the change? How do you know which model is better? And how do you measure that performance in real time? I think these are what, and so I think my sample is a little bit biased because people come to us when they're implementing ML models. So maybe I just think everybody's implementing ML models, but these are the challenges that are more often faced with is, I want to put these in place and I want to keep them up to date in real time, and just kind of putting that into operation, presents a number of issues.
Yeah, I would like to add a few things. Like whenever from a second line point of view, we look at these models, there are like quite a few principles we follow. Like, is the model explainable? Is the model fair? Is it transparent? So these are basically the high level themes. And again, one of the area from a credit side is that's always the most critical is that are we having the right set of adverse actions? Because given if you're kind of declining someone, are the adverse actions kind of defined clearly and kind of adequately communicated? And what I just heard about fraud models a few minutes back, and like the credit and fraud, I believe these two are like kind of totally different set of models. Like in fraud, you can be like much more kind of sophisticated, and credit, it's much more, fraud is like less regulated compared to credit, because fraud is basically you're capturing the bad actors, versus credit, you're kind of deciding how much to extend and who to approve and how much to give. So fraud, you have like much more flexibility in terms of kind of using the data, and you have to be very quick as well, as in like, because you can't, like fraudsters usually act very quickly. So when you think about like what's complex versus what is accurate, so complexity can be higher in fraud models, but accuracy is important in both. But credit, you can kind of reduce the complexity a little bit to kind of go with more with the regulations. That would be my take on this.
Sure. And I heard Javed, probably you're referring to some kind of a reinforcement type of models. And to the extent I have seen the consumer lending world, it is still not there. I mean, I wouldn't say it's not there, but not as heavily coming in, because that's a separate domain altogether where you are real-time refitting the data and updating your models. And again, Ravi, your job would be very difficult to have a model validation.
Yeah, I have seen that like very quick kind of changes in kind of targeting models. We're like who to target, what to offer. But when it comes to like pure underwriting, approval decline, limit assignment, pricing, there I haven't seen it. It's like I would be the first one to say, raise my hand that this is we're going like too fast.
Yeah. You want to see a full accounting of how the models going to behave with each refit, so that you can make sure that there aren't any safety and soundness issues. And so kind of the from our view, same deal. People don't want models that are self-learning in originations, but what they're excited about is the ability to add new observations to those models, new data, more quickly, and to facilitate a quicker review, right? So some of the automation that we're developing helps you to accomplish that. So that you can literally add, another 1 million records, have the refit happen, and then a full model risk document generated that then you can go review. So instead of taking a year to get the refit model into production, you might be able to do it on a faster cadence. That's what we
There's a difference between.
If we see with stress testing happening with some regularity, then you kind of have to have some real-time validation going on, right? Otherwise, how will you keep doing it year after year?
Yeah, so there is always some sort of ongoing monitoring that happens to see is the decision expected in alignment with what you are expecting, what you're taking. Yeah, and also I've seen that the model building document which is generated from these tools and the model is quite easy, but versus when you create the model validation document, that's tough, because you kind of identify the sweet spots in the model which kind of require a zoom in. So these two are kind of very different animals in my mind.
Totally agree. Just respond, Javed, real quick. I wish everybody thought the same way you did about it being okay to use use these types of more complex models everywhere. I think there's just a little bit of maybe perhaps regulatory clarity that would help, because I think folks think otherwise. And so
it's definitely something that doesn't apply equally to all organizations. Okay, like the larger banks are getting more scrutiny. Those are the ones that, as regulator, we would visit more frequently and review the models. But if there's a small bank or small institution out there that's using complex models, I don't think what you would hear the regulator say is the model is too complex, it exceeds our complexity threshold, and therefore you can't use it. In fact, it might very well be the reverse, that you're not using some kind of a machine learning approach. You're just doing some kind of a traditional spreadsheet approach, percentage, historical average, for example. And that may be called out as weakness, and then maybe there's some bias in there towards having AI, there probably is, but I would see it more likely that from a regulator's perspective, you would fail for not having something complex enough. But I don't think that you could fail for having something that's too complex, not for that reason, but you might indirectly fail because of not being able to explain it in the validation, which is, as
agreed.
You mentioned.
Agreed. Yeah, great discussion, but actually we have to cover a lot here. So, and very good questions are coming. So let's move to the next one. But what I'm feeling here in this conversation, probably if we are not talking, if we mute ourselves, I think it will reduce the echo. So that will help. So moving on to our next question, which probably we have touched upon a bits and pieces in our previous conversation, is what opportunities does AI provide when it comes to credit and lending? So maybe this time I start with Ravi, yourself.
Yeah, I would say the first and foremost is the faster decisioning and more accurate decisioning. That's one thing I've kind of seen, like that decision making has become like much more faster, and the discrimination power has kind of improved over time. And of course, it's also fueled by the new data that kind of goes into these models, and then how you kind of process that millions of lines of data and kind of multi attributes to kind of build up the models, which are executed faster, are able to kind of take into account multiple variables and kind of provide near real-time decisioning. Like in both the organization, I've seen pretty much all the decisions that were made for real time. On consumer lending, even on the small business lending side to a certain extent, all driven by data-driven risk management, which takes into account the next current generation or even the upcoming generation kind of risk models, leveraging wide variety of data, historical data coming from pre-recession period, current time period, and kind of weights adjusted and kind of decisions kind of coming in near real time. I still remember like when a couple of years back when I was in my prior organization, this instant pre-approval was launched. Like within fraction of seconds, you see if your card application is approved or declined. And that was in US because you have like much more real-time connectivity with the data sources. Versus if you go back to many countries where you don't have that level of data sources. I still remember like people writing over pen and paper, filling up the forms, and somebody kind of manually typing it up and kind of approving the loan application. That this stage we are like totally surpassed. And now it's more kind of fraction of seconds you get approved for loans, for installment lending, or for credit cards. So that's the place where there's a significant amount of value added I've seen in over the last decade or so. And I believe it will eventually improve further.
Yeah, completely agree. And what I have seen, again, like it has been documented in various papers, and every institution have done some kind of a testing around. I mean, of course, the newer algorithms to great extent is doing a good service in increasing the discriminatory power of the model over what used to be the traditional model, basically the logistic regression models, right? That is there, right? But the open question is still there, is about whether these models are stable over time or not, or robust or not. Question of interpretable, or whether it's explainable versus the transparency that logistic regression brings in. But the dimension which I would bring here is that lift, that additional discrimination power, it is not all across the board, right? If you're talking about prime, super prime type of a customer base, there's still a gain, and it is a very tangible gain, meaningful gain, but it's not as much. But if you're talking about near prime or subprime population, generally you see a more value coming out of these algorithms. Obviously, if you're talking about unbanked, underbanked, where the data, credit bureau data is not available, I mean, I see there is complete upside there, because otherwise these people are completely out of the banking domain. If you can bring them in through alternative sources of data and algorithms, so that you have a way to qualify them to get some credit, that is always a plus. But But the fact here is, again, every company, every financial firm has got a different domain space to play in. That depends on your risk appetite. So based on that, different people might be seeing different value add, depending on which spectrum they're playing.
I would say new data always adds more value. The new and fresh data, especially the open banking kind of things which are coming up now, like using Yardley, Plaid for kind of bank account monitoring data, or bank statement data for small business lending underwriting. I was working on some project a couple of years back, and I saw was working with one startup, and they showed me their model which leveraged like consumer bureau, commercial bureau, application, and open banking data. So open banking data itself was adding like almost 40% value to their model.
Absolutely.
Which itself is a big uplift. Even if you use regression-based model and use that data, see an uplift.
Yeah, I was about to ask, because we don't know, I mean, whether it's value added from the alternative information you're getting in, or it's the algorithm value. Because many times these two people get mixed up, they report it differently, they say it together, but these two are two different things. Like one is additional sources of information, which will improve any algorithm. And then there is separately, you have the power of the algorithms.
Well, and in my view, Chiranjib, they're kind of related, right? So your modeling method, if you're in a logistic framework, you have to worry about collinearity and the saturation of the numerical precision of the computer at the top end of the score range. And so the modeling methods, the machine learning modeling methods are able to deal with many more columns of data, even if they are correlated, to make those determinations. which is one of the appeals, is that you can add more data and you can have the machine sort of sort out how the segmentation's supposed to go to be able to make use of it. One of the things that we've seen in models that have been deployed now for years is that even through the COVID period, when we're adding new observations and attempting to refit the models to see if we could get an additional lift, there isn't any. So the models are kind of stable. And so it's a little, that was kind of surprising to me, but it is kind of panning out that way. And then on the super prime, near prime, subprime question, absolutely, there's a real opportunity to grow the book safely by reaching those new customers. We see on average, a 10 or 15% increase in approval rate with no change in default rate by applying more data, using more data, and using these more flexible models. But even in the upper range, there are things you could do from a pricing perspective to construct a portfolio that has better overall risk, so that you get a higher take rate from the borrowers you really want. And so you could play some really interesting selection games through pricing with models, and the discriminatory power of the machine learning model at the top end helps you do that.
Yeah. No, I mean, completely agree, but only one thing I will advocate to every users is keep your thumb rule to keep things simple, because it's been sometimes exaggerated that there is a huge trade-off between complexity versus accuracy, right? Depending on your case where you are working, depending on your data set, depending on your population, that may not be the case. And if that is not the case, go for a simpler approach. Go for reduced number of attributes, go for reduced number of trees, etc. Right? Because by that, you will be inherently increasing the transparency of the model, as well as you will increase the shelf life of the model. Right?
But you make second line's job easier too, because they don't have thousands of attributes.
Everything looks better that way. But many a times, like, we are all in a hurry. We have to deliver one and then move on to next one, right? In that approach, we fail to test out the simpler versions. Always try the simpler version. If you're not losing much, go for the simpler version. So that's good. Anything else to be added to this topic?
Well,
Javed?
Go ahead, Javed. Sorry.
I was just going to mention one thing. I really appreciate the discussion on the prime and the keeping things simpler in order to achieve implementation feasibility. I think those are very important answers. But also, if you look at kind of the opportunities in lending, there's certainly opportunity in terms of better customer data, reducing, improving default prediction and on the loan book there. I think one of the other areas there's a lot of opportunity is in customer acquisition and marketing. So bringing more people in, and that's where I think there's more innovation going on. So if you look at AI, it's kind of disrupting innovation somewhat. Like innovation previously had been targeted toward the subprime segments of the economy, like with Drexel and new credit products. So when you look at the objective, like Chiranjib in your example, you said maybe there's not that much action in prime, but it kind of depends on whose objective and whether that's going to change things up now that you've got fintech in the game. So for example, if you have two securities both backed by prime, and one's backed by good prime and one's backed by bad prime, if I can short the bad prime and long the good prime, then I can double down on that. That might be a problem for you if, even if you're only thinking about kind of the profitability of your book, all of a sudden you're getting some adverse selection in your book too.
Yep, absolutely makes sense.
I would just like to add one more thing. So one of the best practice that I've seen is to have a champion challenger approach, or like a test and control kind of framework, where you have like one model working on or one framework working on A set of principle and B is like a challenger one, which is kind of the new one. And then always do a compare and contrast on how things are kind of moving up. That kind of gives you like the best amount of learning. On top of that, if you have like some sort of random tests, that kind of things will tell you like where you are really heading. Like, are you just going for sake of being fancy and sexy versus you are kind of really adding?
Yeah, absolutely. Are you really getting any tangible value out of that? That's the best thing we can have. let me move to the next one, because that is a very interesting topic, and that is a talk of the town. I mean, everybody is talking about it. So let's hear what you guys think. So this is specifically about lending bias. What steps can financial institutions take to ensure machines avoid discrimination in lending? Maybe Javed, I start with you first.
Yeah, thanks, Chiranjib. So this is something I think we all have to think about a lot. I just saw an article about a pair of Black homeowners who had an appraisal on their home for about $900,000, and they thought, well, that doesn't seem right. We put a lot into it. And they went and got a white family to kind of pretend to be the residents of the home. And they got another appraisal. It was for 1.4, and they thought, well, okay, basically, how are we supposed to transition our generational wealth if we're getting 50% haircut or whatever on our appraisal? And it's interesting because if you think about a decision that's made by an algorithm wouldn't make such a decision unless it was explicitly programmed to discriminate. And I think that's rarely what we see. We rarely see that an algorithm is explicitly programmed to discriminate. What we see instead is that the algorithms that are free to pick up on anything may well pick up on characteristics that are correlated with the EEOC protected categories to such an extent that your outcomes vary by category, which is discrimination. So you've got to define the problem. Do your outcomes vary by category? And then I think the key to the solution is in the objective function. Okay, this has got to go into the objective function. If it's not, then you're just going to be chasing your tail. So in terms of the objective function, if you just put accuracy, great, you find the best model, right? But now if you segment by those protected categories, the EEOC protected categories, and you look at accuracy, and it could be any kind of accuracy, it could be like a curve-based or regression based, whatever. But if you segment by those protected categories and you get vastly different, statistically different, they're always not gonna be the same, but if you get statistically different outcomes in terms of accuracy across those categories, you've got a problem. So now when you're doing backtesting, are you backtesting just the accuracy of your model, or are you backtesting also the, whether your model is discriminating, or, we call that kind of model risk or operational risk, right? Are you introducing model risk or operational risk by not backtesting for some of those other categories? And I really think as we automate more and more, if this doesn't get explicitly built into the objective function, we're going to have a problem. Because as I mentioned, it's not something that the algorithm is typically not taught to discriminate, but it does so of its own volition. So we've got to have some way to measure that and then put a cost in model selection.
Yeah, I mean, that's actually an excellent point. And I was anyway thinking about bringing that up because, I mean, a lot of innovation has happened in this domain that improves the model's capability to differentiate the events, right? Accuracy part of it. But no problem in this world is one-dimensional. You always have multidimensional problems. So why do the models need to be one-dimensional, right? And what you are trying to say here is, why not I increase my accuracy with a constraint that my fair lending parameter, whatever it is, whatever is the definition of bias we use, is at least maintained or improved, like whatever is the constraint. But it's a going with the multiple objective functions, right? And again, this is a topic, like, it's been talked about a lot. We can talk for hours on this one itself, I'm sure. A lot of thoughts coming to my mind, because in order to do that, the first thing you have to bring in is the modeler need to see both sides of the data. They need to see the accuracy of the data as well as they need to see the protected class. And there was a lot of debate in the industry that whether the modeler should have access to such kind of data or not, right? There's a school of thought which says if they don't access, most likely they will not bring in any bias. And there's a school of thought which says, actually, if they see the data and bring it consciously into their model building, like you mentioned, as a constrained optimization problem, maybe the outcome would be better.
Yeah, it's a real problem, but that's going to hamper growth. And the reality is, I think that it is just very rare. I mean, can you imagine being in today's political environment and you're in a financial institution and you're going to explicitly program in some racism into your model. I just think realistically that doesn't happen. It's more
that doesn't happen. That won't happen.
Stuff where it's going to get picked up on, and so but that is
No,
a very
again,
problem of personally identifiable information. And
let me
that's
clarify what I meant when I said that. Of course, these inputs will not be input to your model. Like when you are doing a constraint optimization, you are putting the criteria that for this group the approval rate has to be same as the other group, or something like that, right?
Yeah.
Either proportionately. You're not directly incorporating them as input. They're not using it, but you're constraining it to improve your bias or whatever.
A good example, a little bit outside the realm of finance, is the facial recognition technologies. So in the facial recognition technologies, in their earlier iterations, they were trained on a bunch of white males. And then not surprisingly, their accuracy for white males was much higher than it was for
there is bias.
Other categories. So there's going to be bias.
There is input bias.
It's not an explicit bias. It's bias that's already in the data, right? And so these credit models are all based on historical lending practice, and quite truthfully, in the past there was bias in that data, right? But Javed, your suggestion of having a dual objective in the learning algorithm is exactly the approach that we're taking in our methods of creating fair alternatives. So literally the model never sees race and ethnicity, but it gets the feedback about whether or not it's fair during the learning process. Mm-hmm. And as a result, we're able to generate models that have 5 and 10% absolute increase in adverse impact ratio. So, much more fair with no impact to discriminatory power from a statistical perspective. Approval rate, 20% increase in approval rate for women as a result of applying these technologies, a 30% decrease in differences in approval rate for African Americans and Latinx applicants. So it's exactly that idea. And kind of the separation of data is preserved because the modeling team never needs to see the protected class membership status. This is something that can be done in a fair lending analytics capacity separate from them. And so it's a little bit like automating the fair lending testing and fair lending LDA search process that happens at our largest institutions, but by using a much more thorough search space to explore the alternatives that are possible using these more flexible models.
Yep.
I would say there should be at least fair lending data-driven analytics should be there as a basic thing in credit organization, because I've seen sometimes the basics are not even there. Like, for example, controlling for risk, is the approval rate similar for men and women? Do you have your
or the limit, right? Because we had the Apple example where the husband got a 40% larger credit limit than his wife.
And there's all sorts of stupid stuff, right? Like you ask for the college they went to and their college major on the one application.
Those are fair game. Those are fair game. Those are not protected categories. I mean, if something's not a protected category and you happen to know it,
but really highly correlated, right? Might be considered.
You don't know a priori what matters.
So I have to interject here because we are running out of time. So we have the last question, maybe 30 seconds from each one of you on that, what you think. So before we wrap up, so what do you expect the future to hold when it comes to AI and lending in 5 years? I mean, previous one was a great discussion. We can continue on that one for long, maybe offline. But yeah, let's focus on this one, 30 seconds. Maybe, Ravi, we start with you.
So I would say 5 years from now, it's a very tricky question. Nobody knew what was about to happen in 2020. So it's kind of, first and foremost, my hope is that COVID will be over and then we'll be back to normal. That's my biggest hope. Second hope I have is that we will be moving again back to the product mix that we had in the past, like people again going back to like T&E kind of spending, and the products which are more kind of T&E kind of thing, more longer term products, more kind of revolve products will again come back to kind of prominence, which suddenly is kind of totally shrunk. And it's right now it's more kind of short term lending kind of coming in, and those kind of lending kind of again coming up, and you will have much more richer data kind of come in as the time progresses, which again will come from interaction with the brands. like what products you use, and again, using that data and more into your underwriting and kind of targeting decisions. So again, back to normal with more data. That's the way I would think about next 5 years.
I think a lot of what's going to happen is going to depend on the macro environment. But one of the things I see happening is, so Ravi had this discussion of kind of the human in the loop on the loan approval timeframe, and this reduction over time as we implement AI. I think one of the things we're really going to see is additional targeting of that human in the loop component of the ML, and hopefully, reduction of that to close to zero in most situations.
Yeah.
I just add, I think we'll all be asking ourselves, or financial institutions will be asking ourselves, why didn't we do all this sooner? Because the benefits are so clear.
Absolutely. I mean, I agree with you. I mean, I would think that bank the gain you can, make smaller strides, start using it. And don't think about like first step, reinforcement model, deep neural net. No, there are simpler things. And from that perspective, we do a disservice by calling only 4 alphabets, AI and ML, to define all gamut of algorithms we have. Have some categorization, have some standardization that these models are simple, okay to be used for X purpose, more complex required for something else. So anyways, we are out of time here. We'll just wrap it up. Good discussion.
Yes, thank you all. I wish we had more time, but unfortunately we have to move on to the next session. So I'd love to say thank you to all of our awesome panelists, and thank you, Chiranjib, for moderating. That was wonderful. We really appreciate all of your insights. All right, for the audience, go ahead and make your way to your next session. And along the way, make sure to accept your connection request and check out our awesome AI exhibits. Thanks so much, and we'll see you around.
Thank you.